Hello everyone, welcome to the 167th episode of me learning how to trade in Forex. In the last episode we went through the basic chart patterns part 1. So as we've seen before, when the market hits significant support or resistance levels, it tends to either bounce off or break through, apart from fake outs of course. If you could forecast or predict when the market was going to do which, you would be minted. Unfortunately, markets are unpredictable, so that's not possible all the time. But the good thing about technical analysis is that various chart patterns tend to repeat themselves. So, if you can learn to recognize these patterns and when they start to form, then you can often gather clues about what the price is going to do next. But remember that these patterns are by no means guaranteed, and they should just be used as guides to the future directions of a market. So some of the chart patterns we went through are double tops and bottoms. So double tops and bottoms are reversal patterns, signaling that a sustained trend may be about to reverse. So double tops occur when there's two successful moves higher are sold into, creating two peaks on the chart. And then the low point between these two highs was known as a neckline, and the pattern culminates with a breakthrough this level. So it looks like a V basically, and then breaks through trend reversal, so uptrends, and then goes into downtrend, right? And then the projected rise is basically the distance from the high, the peak or the trough to the neckline. Then we went through the triple tops and bottoms, basically same as the double tops and bottom, except the market hits a support and resistance level 3 times before reversing. So 1, 2, 3, and then reverse, instead of the usual 1, 2, and reverse. So this is the triple bottom. Nope, it's a triple top. This is a triple bottom. And then we got the head and shoulders pattern, basically one peak and then a higher peak and then a lower peak. So looks like a head between two shoulders. And neckline is formed between the two troughs on either side of the head. So if the neckline is sloping down, that's an even better indication of reversal. And then we got a inverse head and shoulder, basically upside down normal head and shoulders. Then we went through the lesson summary, and now we're on to basic chart patterns part 2. So basic chart patterns part 2, 15th. In this section we'll look at 4 more patterns that are commonly identified by technical analysts. So triangles. These occur when a market price starts to converge towards a single point. How the triangle is formed can give an indication as to where the price will move next. There are 3 main types. So we've got triangles. Triangles occur when a market price starts to converge towards a single point. Starts to converge towards a single point. How the triangle is formed can give an indication as to where the price will move next. So how the triangle is formed will give an indication as to where the price will move next. Will give an indication as to where the price will move to next. So the 3 main types of triangles. Ascending triangle forms as the market hits a strong level of horizontal resistance, but a series of high troughs indicate that the price is converging towards it. An ascending triangle forms as the market hits a strong level of horizontal resistance, but a series of high troughs indicate that the price is converging towards it. So ascending triangle forms as the market hits a strong level of horizontal resistance, but a series of higher troughs indicate that the price is converging towards it. Indicates that the price is converging towards it. This pattern usually signals that the price will move higher, but bear in mind the resistance level might be too strong, causing the price to bounce off. Generally, a sensible way to trade triangles is to wait until the pattern is formed and then trade the breakout. So this pattern usually signals that the price will move higher, but note that the resistance level could still be too strong. And cause the price to bounce off. Generally, a sensible way to trade triangles is to wait until the pattern is formed and then trade the breakout. So the sensible way to trade the triangle is to wait until the pattern is formed, and then trade the breakout. The sensible way to trade the triangle is to wait until the pattern is formed and then trade the breakout. So you can see there's a strong horizontal resistance here, so price bounce here, bounced off, hits here, bounced off, hits here, bounced off, hits here, bounced off, hits here, bounced off. But there's actually, the troughs are beginning to converge towards that point as well. So one trough here, trough here, trough here, trough here, trough here. So the trough is gradually becoming higher and higher towards the resistance. And then the breakout point is around here, boom, where the price shoots off. So that's, at that point is where we basically place the trades. Yep, a descending triangle works in the opposite way to an ascending triangle. The market hits the level of support, but a series of successively lower peaks suggests the price will move lower. So descending triangle forms as the market hits a strong level of horizontal support, but a series of lower peaks indicates that the price is converging towards it. This pattern usually signals that the price will move lower, but note that the support level could still be too strong and cause the price to bounce off. The sensible way to trade the triangle is to wait until the pattern has formed and then trade the breakout. So I should probably name the ascending triangle the ascending triangle, the descending triangle, then we've got image here, so here we can see we got the strong level support where price hits here, bounces off, doesn't reach here but basically still bounces off, and then bounces off here again. So but the highs are getting gradually lower, so it's gradually coming towards the support level, and then breakout point is here, boom, all the way down. So that's the descending triangle. And we've got a symmetrical triangle. So symmetrical triangle occurs when the price appears to be converging with a series of lower peaks and higher troughs. This is a continuation pattern, which means that the market will usually continue in the same direction as the overall trend after the pattern is formed. So these are all continuation patterns, right? Because yeah, they're all continuation patterns because the ascending triangle also just trying to go up. Descending triangle, the trend before was downwards as well. And a symmetrical triangle occurs when the price appears to be converging with a series of lower peaks and higher troughs. So coming into a sideways trend, I guess, occurs when the price appears to be converging with a series of lower peaks and higher troughs. This is a continuation pattern. This is a continuation pattern, which means that the market will usually continue in the same direction as the overall trend after the pattern is formed. Which means the market will usually continue in the same direction as the overall trend after the pattern has formed. So that's the diagram. So lower peaks and higher troughs. So the peaks are getting lower and lower. This isn't really a complete pattern, to be honest. It's just I guess this bit is going on a downtrend, and then we got lower peaks. So this is the peaks are getting lower. The troughs, I don't really know where they're getting higher, but continue the same direction, and then the downward trend resumes. Right. If there's no clear trend before the triangle, the market is equally likely to break out either to the upside or downside. However, if there's no clear trend before the triangle, the market is equally likely to break out either to the upside or downside. That's that. And we've got rectangles, similar to symmetrical triangles. These are continuation patterns that mark a consolidation period in the current trend before the price continues to move higher or lower. After a strong move, the market will often trade in a tight range between support and resistance levels, establishing a clear rectangle shape. After that, the market tends to continue in the same direction. So, rectangles are continuation patterns that mark a consolidation period in the current trend before the price continues to move higher or lower. So, are continuation patterns that mark a consolidation period. Consolidation periods in the market in the current trends before the price continues to move higher or lower. Before the price continues to move higher or lower. After a strong move, the market will often trade in a tight range between the support and resistance levels, establishing a clear rectangle shape. So after a strong move, the markets will often trade in a tight range between support and resistance levels, establishing a clear rectangle shape. Establishing a clear rectangle shape. After that, the market tends to continue in the same direction. After that, the market tends to continue in the same direction. Tends to continue in the same direction. So, market often trade in tight range between support and resistance. Oh no, resistance and support. Tight range, so it keeps bouncing up and down between it. And then we've got this rectangle shape. After that, the market tends to continue the same direction. So, before here, it was probably going up as well. So it was going up to here, and then trade in the rectangle, and then continue going in the same direction. That's rectangles. Wedges, not to be confused with triangles. These patterns are formed when the price of a market begins to narrow into a tight range between two sloping trend lines. Wedges, so we've got a falling wedge and a rising wedge. Wedges are formed when the price of a market begins to narrow into a tight range between two sloping trend lines. So we've got rising wedge. Rising wedge occurs between two upwardly slanted lines of support and resistance. So rising wedge occurs between two upwardly slanted lines of support and resistance. In this case, the line of support is steeper than the resistance line, so the support line is steeper than the resistance line. This pattern generally signals that the price will push lower. So This pattern generally signals that the price will push lower. Whoops, take here, like that. So, rising wedge occurs between two upwardly slanted lines of support and resistance. In this case, the line of support is steeper than the resistance line, so this line is going to be steeper than that line. This pattern generally signals that the price will push lower, so it's a reverse. I was going to say, is it a reversal? Yeah, it's a reversal pattern, isn't it? Because the general trend up here is going upwards, but then over here it just drops. So it's a reversal pattern. A falling wedge occurs between two downwardly sloping lines. In this case, the line of resistance is steeper than the line of support, and usually signals that the price will rise. So, falling wedge is basically the opposite of rising wedge. So, falling wedge occurs between two downward slanted lines of support and resistance. Downwardly slanted lines of support and resistance. The support line is steeper than the resistance line. I think in this case the resistance line is going to be steeper than the support line. So the resistance line is steeper than the support line. This pattern generally signals that the price will move higher. Will rise higher. In this case, line resistance steeper than line support and usually signals that the price will rise. Yep. So resistance line, this line is steeper than that line, and then overall trend over here is downtrend, and then it signals a reversal into an uptrend. Remember, chart patterns are not guaranteed. As we noted in the previous section, chart patterns are merely signals to as where the price of an asset might go in the future. With all chart patterns, it's sensible to wait until the direction of the move has been established before placing your trade. Remember that chart patterns are merely signals as to where the price of an asset might go in the future. Are merely signals to where the price of an asset might go in the future. While with all chart patterns, it's sensible to wait until the direction of the move has been established before placing your trades. It's sensible to wait until the direction move has been established before placing the trade. In some cases, when a breakout looks likely, it can even be a good strategy to set orders either side of the support resistance trend line. Then when one of the orders triggered, you can cancel the other, hoping to catch the breakout whichever way it goes. However, this strategy is still susceptible to fake outs, so whenever you place a trade, it's important to set stops to limit your risk. Set stops to limit your risk. And then with the placing order, regarding to placing the order, so there's like different order types that we've learnt the previous lessons. So it's like good until, so if one trade has been triggered, then the other one automatically cancels. So place that type of order there. And yeah, so yep. Lesson summary then. The following chart pattern suggests the market might break out to the downside. Rising wedge, descending triangle. I've probably done it. Falling wedge, ascending triangle, yep. These continuation patterns suggest the market could continue its current trend. Rectangles, symmetrical triangles, yep. So rectangles, symmetrical triangles, continuation patterns, yep. So good. And now we're on to candlestick patterns. So candlestick patterns. Under 15. So candlestick patterns. When conducting technical analysis, it's often advisable to use more than one signal, pattern, or indicator to inform your trades. So it's good to use more than one signal, pattern, or indicator to inform your trades. The market don't always follow chart patterns, and every potential breakout could turn into a fake out. So the more signals indicating that a market will move in a certain way, the more confident you can be that the market is likely to behave in that way. Candlesticks are particularly useful as their shape can give you clues as to the balance between buyers and sellers. Some types of individual candle are so distinctive. Some types of individual candle are so distinctive they have their own names. So, marabuzo, bullish. So, large body, very little or no wick. This candle shows that the buyers have pushed the price up significantly from open to close. So, marabuzo, bullish. Large body, very little or no wick. Shows that the buyers have pushed the price up significantly from open to close. Have pushed the price up significantly from open to close. So potential direction, I'm assuming that means the potential. Okay, there's no point making it that big. Okay. Let's just do 20. Marabuzo, bearish. Marabuzo, bearish. Large body, very little or, should we say or, no wick, shows that the sellers have lowered, shows the sellers are in complete control. Bearish candle shows completely control. So opening, closing. Closing is way below the opening, whereas for this one, opening, closing. Closing is way above the opening. So if the closing is way below the opening, then that means basically no one's trying to buy the asset and everyone's trying to sell it. So there's an overwhelming supply and there's basically none demand. Spinning top. These have small bodies and wicks that are roughly the same length above and below. They tend to indicate indecision in the market and are often seen during periods of consolidation following an uptrend or downtrend, or at market tops and bottoms. So, I forgot to take a screenie of that. So spinning top have small bodies and wicks. Have small bodies and wicks that are roughly the same size, same length above and below. Tend to indicate indecision in the market. Often seen during periods of consolidation, following an uptrend or downtrend, or at market tops and bottoms, So the potential direction shows you where might the potential direction of the market go after this has occurred. So this one, don't really know, because there's indecision in the market, so no one really knows where they want to go. Doji, also frequently signify indecision. These have almost no body at all, meaning the opening and closing prices for that candle are identical, or at least very close to each other. The wicks can be any length in either direction. Doji is typically seen during consolidation on market tops and bottoms, or bottoms. It can also indicate that a trend is about to reverse, as the conviction of buyers or sellers driving the market weaken. So doji, also frequently signify indecision, have almost no body at all, meaning the opening and closing price for that candle are almost the same. The wicks can be any length in either direction. Signifies indecision. Typically seen during consolidation and market tops or bottoms. Can also indicate that a trend is about to reverse, as the convictions of sellers/buyers driving the market weaken. I just thought of something. So in the future, future me, after I've gathered all the information I need and is tidying all this up into something readable. For the candlestick patterns, I could just basically make a table with the headings like what they look like, where they're normally found, what does it mean, how to spot it, what potential direction of the market might come after that candle, like that sort of thing, you know, just to make it easier on the eyes. So, note to self, that is. Right, okay, so cheeky little video here.
One of the most commonly talked about candles out there is the doji candle. Now, dojis are formed when the open of the candle is equal to the close of the candle, and for a standard doji formation, you can see price action move both towards the upside and towards the downside of that open and close level to form long legs. Now, commonly found within the markets at tops and at bottoms, dojis actually show indecision within the markets where there's a fight between the bulls and the bears. Hence, we actually see an equal open to close of the candle. Now, if we take a look at the charts, you can see here the chart for cable back in October actually bottomed out around the time that we saw this doji candle flanked either side by two spinning tops. These are indecision candles, and on this occasion we did actually see the market turn upon seeing these three candles.
Okay, very nice. Hammer. When seen during a downtrend, this candle can signify that the market is about to go up. So, hammer. When seen during a downtrend, this candle can signify the market is about to go up, so reverse basically. For a particular strong signal, the lower wick of the hammer must be at least twice as long as the body, and there should be little or no upper wick. So for a particularly strong signal, the lower wick of the hammer must be at least twice as long as the body. There should be little or no upper wick, Colour of the body is not especially important, but green hammers tend to be more bullish than red ones. The colour of the hammer isn't important, but green hammers tend to be more bullish than red ones. So here inverted hammer, I'm assuming it's the opposite of normal hammer. Similar bullish candle, which when seen in a downtrend can signal that the market is about to move higher. The only difference to a standard hammer is the upper wick is long, while the lower wick is very short or non-existent. A similarly bullish candle, which when seen in a downtrend can signal that the market is about to move higher. Wait, so it's the same thing as a normal hammer then? I thought there was going to be a difference. Similar to hammers. Oh, nice. Forms after a downtrend, so it will form after a downtrend. inverted hammers. So well, everyone's call it different names. Right, okay. Inverted hammer, so they all form after downtrend, right? When seen during a downtrend, this candle can signify the market is about to go up. There should be little or no lower wick. Then we've got the hammer here. Very good. Hanging man. Same shape as a hammer, also signifying a reversal, but this time formed during an uptrend. Again, the colour isn't particularly important, but a red candle tends to be more bearish. So here we go, hanging man. Also signifying a reversal, formed during an uptrend. So when seen during an uptrend, this candle can signify the market is about to go down. There should be little or no upper wick. The color of the hammer isn't important, but red hammers tend to be more bearish than green ones. Yep. So let's start. Shooting star. Seen during an uptrend, this candle can signify the market is about to go down. There should be little or no lower wick. Another reversal candle occurring during an uptrend, same shape as the inverted hammer. Yep. Should have called this inverted hanging man or something instead of calling it a complete different name, you know. But anyways, so that's that. Yep. So that's shooting star. Just like chart patterns, multiple candlesticks can also form recognizable patterns that often signify the market moving one way or another. So we just went through all the single candlestick or noticeable. Yes, noticeable or distinctive. There we go, distinctive single candlestick patterns. I'm going to leave this episode here then. So in the next video, we're going to go through the 2 candlestick patterns, followed by 3 candlestick patterns, and yeah, so just leave it here. Thank you all for watching, and I will see you guys in the next video then. Peace.